So moving further along into the subject of stock options, we're going into the two basic types of options used in the stock market, puts and calls. And again, I'm going to reiterate something. Whenever I say to an amateur investor the market might crash and they get all upset and they want to argue with me and all this, I know they're an amateur at that point because they don't understand puts and calls or options. And because a professional investor doesn't care if it goes up and doesn't care if it comes down because they'll protect their position either way. Another word for options is the word insurance. In the stock market, this is also called a hedge. It means a little protection. You want to put a barrier around your value of your stock. So let me give you an example. Again, this is very simple, extremely simple, oversimplified in fact. But the subject of puts and calls as far as options goes is one of the more complex, and sometimes it takes massive amounts of brain power that I don't have to explain it. But let's keep it very simple for the start right here. So let's just say you buy a stock at $10 and over time the stock goes up, and let's say it's $50, and now you're afraid the market's starting to look like it can't go any higher. At this point, a professional investor say, I don't want to lose my $50 position. At this point, a professional investor may buy what's called a put option. The key word is that they will buy this option. Now what a put option allows you to do is this is insurance. In case the stock does, as they suspect, come plummeting down back to $10, they don't lose everything they've gained in this area. So what a put option in this case would allow you to do if he purchased it would allow the buyer to sell stocks at $50. So a put option allows you to sell a stock at $50. So even though the stock today is at $10, the put option is your insurance saying somebody has to pay you $50 for insurance. So that's why options are so important, especially in the stock market, because you don't want to ever invest without insurance. You don't drive a car without insurance. You don't own a house without insurance. And many people invest without insurance. That's ridiculous. It's also called being naked. It means you're out there exposed. Moving along to call options, let's say the stock chugs along and you say, I think the stock's going to go back up again. Certain things are happening in the company. People are getting excited about it. And you don't want to miss the move up. At this point, a person may buy again, keyword is buy, a call option. So what happens is, let's say you're right, and the call option may cost you $1 or $2, put maybe the same price, so not very expensive. And let's say the price suddenly goes up back again to $50 again. What a call option allows you to do, or a put allows you to sell, a call allows you to buy the share at $10 even though the stock is at $50 that day. So this is a very simple way of how professional investors either buy or sell in their use of options, puts, or calls. This is extremely simple. Took me a while to get my head around it, so please take your time in understanding it. If you need to rewind and look at this again, please do so, because it's very important to understand how professional investors use puts and calls. Once again, in this situation, by buying a put, if a stock fell down to 10, the put allows me at this point to sell my share at still $50 even though the price is at 10. And in this case, if the stock market moved up to 50, the call option would allow me to buy shares of this stock at $10 even today the price is at 50. So options are a very important way that professional investors invest, and these are the two basic ways: puts and calls and options. Thank you.